Today's focus is on Tesla and the post-split movement of the stock price. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters. Your support is greatly appreciated. If you're not a Patreon supporter, you're missing out on daily trade blasts, along with a lot of other information that would be helpful in your trading process heading into a pretty important period for Tesla right now. So without further ado, I wanted to articulate that in today's show, we're kind of going through perhaps two segments primarily. The first segment is sort of background on general investing and trading, and then we sort of get into, sort of an intense conversation about how the schedule for Tesla looks over the month coming and how one manages that environment well. First of all, I wanted to note that this has actually been a very challenging show for us to put together at this level. And the reason is that there's a guy named Peter Lynch who wrote a book called One Up on Wall Street. And in the book, he really lays out some awesome fundamentals to good investing process. And so one of the underlying strategies of our show has been to embrace the process articulated by him in his book. But I also wanted to note there's a gentleman named Jim Michaels from Forbes magazine. I actually worked at Forbes as an intern when I was in college, and Mr. Michaels arranged for me to be there and was one of my most important instructors. And just like Peter Lynch, he's a very fundamental type of investor, focusing on making sure that the fundamentals of both the company and the stock are solid as you go into your investment process. Mr. Michaels built Forbes magazine up, and I still read the magazine, and I think it's a great publication that has a lot of value in terms of investment knowledge. So the two stages I was wanting to focus on today is sort of background of how we're arriving at our investment circumstance we're in currently, jumping into what Tesla is going to be doing over the next few weeks, and how one considers managing it. So first, a brief tale of economics and supply and demand. There's a company called Chesapeake Energy that just went bankrupt. For me, it's kind of one of the most important stories of business over the last, let's say, 50 years. The former CEO of Chesapeake committed suicide, I believe it was 4 years ago, by ramming his pickup truck into an abutment of a bridge at very high speeds. What actually happened in that circumstance is, I want to call it a mistake of economics 101. What happened is that he helped create fracking. And so Chesapeake developed fracking and had one of the largest amount of land prepared for fracking, all around, genius when it came to fracking. Around that time, oil prices had bounced up to about $140 a share. And what happened is that he put a hedge in at about $80 a share, meaning he shorted the stock with the market at $80 a share. And so fracking started increasing dramatically under his guidance. So even though he was the CEO of this company, he could see the increasing oil flow that was provided by Chesapeake from fracking. He actually went ahead and first shorted at 80 when oil prices were at 143. Oil prices fell to 80, at which point he sold off all of his shorts or hedges on oil, and oil prices promptly went from $80 a barrel down to $25. That put his company in jeopardy. He was fired, started another company. And I was kind of blown away by the circumstance because there's a whole supply-demand equation that you had to understand that would impact oil prices. Way more supply provided by fracking resulted in way too much supply, and the U.S. becoming the largest exporter or producer of oil, if not exporter, once they were allowed to. And so this circumstance is basically what has sort of damaged fracking back when he committed suicide and most recently with a lot of those companies going bankrupt. Now, I segued over there because as we move on and globally look at what's going on with Tesla, there's a bunch of different counterweighing variables that I wanted to look at, not because I want to elongate, but because I want to be thorough. And there's something called bonds. So what's going on with bonds right now? Well, the yield that the Fed is offering is so low that it's not worth the time of investors. So basically what's happening is that you have a situation where retirees or others who need income growth, they can maybe do it through a stock that's rising in value. They can do it by identifying high dividend yield stocks and focusing on them. And so I'm kind of bringing up this circumstance because there's a challenge that's going on right now for the general market, which is, there's a concept called historical PEs. So one of the things we've been talking about a lot is the fact that if you take the earnings of a company times the growth rate of the company, that equals the stock price. Well, one of the things that's going on right now is that because bond yields are so low, consumers are either individually or with the companies they're working are choosing to go over to the stock market, which helps fund companies better. The problem that's happening in the stock market, though, is that the number of companies actually growing fast enough to justify investing is slim in number. So those companies tend to get bid up. Tesla is an example, Apple is another example. But there ends up being this strange situation where people will say, well, I know I'm supposed to invest in stocks. I know we're supposed to focus on high growth, good companies. But once a company kind of outruns its valuation, where to invest? And the answer is that a large number of individuals or institutional managers will move over to companies and start giving them higher PEs or price earnings ratios, even though it's undeserved because the companies aren't growing that fast. They're sort of in a pickle. They have to invest in stocks. They can't invest in overvalued stocks, if you will, and so they're stuck giving higher valuations. So what this results in is that the historical PE over the last 100 years is somewhere around 19. It could be lower than that. But our PE right now, or price earnings ratio for the market, is up in above 25. So this is usually a source of concern for many investors because anytime you have a very high PE and the companies really don't support the growth rate I just described, you have this nightmare where this is why they predict market crashes. So I wanted to bring this up just because Tesla is rising nicely, and up until about $1,500, $1,600, you could justify it based on its growth rate and prospects as we roll over the next few years. But we've sort of gone beyond even for Tesla because of the split and the impact of the supply and demand relative to shares as they enter the S&P. So we have a situation now where I wanted to sort of introduce a cautionary tale because a number of good friends in our trading group got smashed on Tesla earnings and the explosive growth in price not occurring. So I wanted to sort of introduce the general idea that given that we're at the top end of the PE ratios out there, a lot of professional managers are suggesting that we're kind of in a zone where caution is in order because corrections really tend to happen in this circumstance. Will it happen? When will it happen? Nobody knows, but I don't think it's a bad idea to have it in mind of how this whole process works so that you don't get smashed and it'll be a surprise. What I like, and part of my show strategy is if I tell you about the smashing that's coming in general and you have it in the back of your mind, I feel great because if it happens, it wasn't like you weren't warned. You were thinking through what you're doing, mindful of the fact that that's a lurking issue that's out there. Now, on to Tesla. We had a great week this week. We predicted 2100 was where it was headed, and we gave you reasons 5 shows ago. We're now in the neighborhood of 2100, and the answer is what's next and why. So really, 2500 is sort of the next major hurdle that's been articulated by large investors of where things are going based on analyst upgrades. So they've done it'll be a $1,900 stock, but the bull case is $2,500. So I wanted to sort of break out a knife and fork and kind of look at, like, where are we going over the next couple of weeks, why, and what impact should it have on the stock? So I'd have to say that this is a little bit difficult because it's as though, you're driving a train and there are 3 tracks this train could go in, and it's like a guess which one it's going to go through, but you want to be in the right track to catch that train in theory. So right now we're in a situation where the analysts that we talked about at S&P predicted 2,100 as a target price for the stock based on how the introduction of Yahoo impacted the S&P 20 years ago. We're now at that number, and the question is, what's next? The challenge with this is the fact that you've already arrived at a number that you weren't supposed to arrive at for another, theoretically, 3 or 4 weeks. So we're in a very, very interesting position because basically what's going to happen right now is that I think that the stock price is going to rise maybe 5 or so percent, possibly 10% between now and the split, which occurs the 31st. Now, anytime you do a split, I always find it kind of interesting because there are some rules of thumb of how it works. And I've watched a few of them, been part of them, even on Apple, actually. And I was sort of intrigued because after the split occurs, you look in your account and go, oh, no, my price is down. And then you're like, oh, yeah, I have a lot more shares. So I kind of knew it was coming. But that first week or so, there's this process you go through where you're like, oh, the split gives me this price. But if I multiply it by 5 in case of Tesla, I'll know what the price might have been prior to the split. So it gives me a general feel for where the numbers might be. So what also happens here is that typically there's a range of value increase for stocks. Somewhere in the 5 to 10% is normal, but this isn't normal times for Tesla. So I think that our range minimum is a 5% up after split. But I think that number could be somewhere in the 10 to 15% range because Tesla has been so crazy right now. And the driver for that is that there's a split, and so people have more shares. But there's also a large group of people who want to invest in the stock and can't afford a $2,000 stock price. So as that price drops down into the, call it, $300 to $500 a share, there are a whole bunch of people that can afford to own round number of lots of shares in the company and will choose to buy. How many of them are there? What will happen? You don't know exactly what that is, but I think it's 5%. You'd be safe to say, yeah, it'll do that in terms of the market. 10% maybe, 25%. Hard to see that happening because of how wide the gap is between the fundamentals of the company right now already. So I think it'll be the increase post-split will be on the lower end of the range. So if we next go to post-split, we're now facing up against sometime in the next month what's going to happen with the S&P, and I think the addition will occur after the split at some point. So now we're in an interesting position because remember the conversation we had about Chesapeake Energy and supply and demand. Heavy supply resulted in prices dropping dramatically. So that said, I just think that we still have a supply problem. Low supply of number of shares available of Tesla results in higher prices. So I think that what this sets up for is a 5 to 10% increase post-split at least. Number could be 20. And then as we enter the S&P, at least a 5 to 10% increase related to that as well. So theoretically, prior to earnings or around earnings at the end of the month in September the 22nd for Tesla, all of this puts us about 15 to 20% higher in the value of the stock than we see now. So that's where we get above 2,500, but below 3,000 is kind of the target range. So given all that action that we see coming in that month, it's our estimation then that what we're going to see is by the end of month, we could be in that $2,700 to $3,000 per share range. And then we see what happens from there. Does China finish and start delivering Ys, and the Chinese production numbers blow up and start giving us really good numbers that could justify a higher stock price is what I think is lurking as a possibility right now. So in general, I'm excited, made a few dollars on Tesla's rise this week. I think that there's wild movements in the stock, obviously, but if you base everything on what tends to happen with different companies in the same circumstances, Tesla, you can pretty easily see a 10 to 20% rise in value over the time that I've just described. And now this shows up where we talked about different train tracks you can go through. One of the arguments against this is, for example, in a down market, obviously that could change. We also have the problem of instead of waiting for the new change in environment, be it split or S&P to happen, the stock price is actually anticipating the move in terms of how the stock price is running. So I think this adds a measure of unknown to the environment and makes it more difficult to trade. In terms of ownership of stock, it's terrific because you're making more money. But I just think that the trading side of this house becomes a lot more challenging. The one last thing I wanted to review, and you've seen this with Tesla happen, and you're going to see it probably every 4 to 6 weeks for the next year, and that is that the run for the hills phenomenon. So whether it's triggered by the bots and the hedge funds or some bad economic news or something happening bad, one of the phenomenons is any stock that's at a very high PE, meaning a very high PE ratio like Tesla, is always subject to the run for the hills phenomenon if the market turns bad. So the companies that have not run up very much are pretty much in line with the price where they should be. Companies like Tesla have kind of run ahead of their fundamentals, as we've discussed. And so what this tends to mean is that you can get smashed in the short term because what people don't do when something bad happens, some bad news occurs, et cetera, they don't immediately say, Tesla's good, let's stick with them. What they say is, let's look at all the high PE stocks like Tesla, let's sell them all instantly. And if everything is fine, we'll buy back in, but we don't want to get killed. So do not be surprised if you see some dramatic, particularly down movements of Tesla stock mixed into this period of really good upside because there's a lot of nervousness in the market that a lot of folks should have sold out and been sitting in cash right now. And if there's any sort of little trigger out there that prompts fear, I think you end up with this thing sort of stopping and dropping pretty dramatically. So, note of caution in a number of different ways at different points in the show. I definitely wanted to present that to you. So, now that I've given you what could happen, may happen, et cetera, what I actually think is going to happen is pretty much what I said. I think that the stock stays steady or slightly up for the week. We maybe get into the 2300s, split occurs, we pick up another 5, maybe 10% on the stock price, split adjusted, obviously. And then we head into, what's going to happen with the S&P from there, another opportunity for the stock price to rise again. And so I think that weather is good for Tesla. I think the secret weapon of China is still lurking there to deliver some benefits. I would be stunned if the Model Y was not begun sales in China, built in China Model Ys by September, because I actually think the factory's already done. It's just a matter of getting cattle to provide the batteries necessary to make that work. So, we'll keep you posted on this, obviously, but as the other thing, as a lot of people were talking about, will Tesla fall back to its normal fundamentals after the entry to the S&P? I think that could definitely make sense because you do need some fundamentals to be attached to what's going on with the company for everybody to continue buying. And so that wouldn't be a surprise to see that occur. I just don't see it occurring between now and the 22nd of next month when I think that we get the S&P inclusion, et cetera. At any rate, I want to take time to say thank you for joining us once again. Please remember to like and subscribe. Also, 25 leg lifts a day will reduce the chance of knee issues. Also wanted to encourage you to consider a 5-2 or other diet in the fasting area. Also wanted to mention no more than once a week for fried foods if you want to stay healthy. Any rate, wanted to say tschüss in German, au revoir in French, lehitro Hebrew, choda hafez Farsi, salam, assalamu alaikum Muslim, ni hao ma, hello in Chinese, zdravstvuyte, hello in Russian, do widzenia, goodbye in Polish, and in Jamaica we say hey do in Swedish. In Jamaica we say enough respect, walk good man. Thanks for joining us. We look forward to your comments here, and let's go get that extra 20% on Tesla's stock price. Have a great day, and bye for now.